All right, welcome to the Explainer. We hear it all the time. The stock market is just this wild, totally unpredictable beast. But what if that's not the whole story? What if underneath all that daily chaos, there's a kind of deep, fundamental logic? Well, today we're going to try and uncover it.
I mean, it's a question that's been bugging investors, even the top economists, for decades, right? On any given day, it can feel like a total casino, just bouncing around based on headlines, gut feelings, and, well, what feels like pure random luck.
And hey, if you feel that way, you are in really good company. We're talking Nobel Prize winners here, like Richard Thaler, who's basically thrown his hands up and said, I admit to not understanding it. So yeah, it's no wonder so many of us just assume it's all random noise.
But what if all that chaos is just one side of the coin? The stuff we're digging into today suggests that the market isn't one single thing at all. Instead, think of it like a constant tug of war, a battle between two completely different personalities, and each one is driven by a very different kind of trader.
So here's how that internal conflict breaks down. On one side, you've got your informed investors. These are the detectives, they're digging into the fundamentals, trying to figure out what a business is really worth long-term. And on the other side, you've got the noise traders. They're the surfers, riding the short-term waves of news, hype, and momentum.
And this visual is just perfect for showing how these two groups interact. So that crazy jagged line, that's the daily stock price. It's getting tossed all over the place by the noise traders. But then, you see those blue bands? That's the zone of what the company is actually worth, its intrinsic value, as figured out by the informed investors. They act like this powerful anchor, like a center of gravity, always pulling that wild price back towards what the company's fundamentals say it should be. The noise creates the waves, but the value is the anchor.
Okay, so if these informed investors, let's call them the smart money, are the ones setting the real boundaries, what are they actually looking at? What are these all-important fundamentals that seem to matter so much in the long run?
Well, the research shows that it pretty much all boils down to two things, just two key drivers that account for almost all long-term value. First, can the company grow its revenue over the long haul? And second, and this is absolutely critical, how good is it at turning money into more money? That's what we call return on invested capital, or ROIC.
And this is where things get, well, kind of weird. Because when you look at the market through the lens of these two drivers, it completely flips our usual understanding of common labels. Things like growth stocks versus value stocks.
Okay, check this out, because this is fascinating. The data shows that what we call growth stocks don't really grow their sales all that much faster than value stocks. I mean, look at that chart on the left. They're pretty similar. The real difference, the game changer, is on the right. It's their return on invested capital. The so-called growth companies are just ridiculously more profitable. We're talking a median ROIC that's more than double the value companies. That's the secret sauce. That's what the smart market actually cares about.
And this whole case for fundamentals gets even more powerful when you stop looking at days or months and start zooming way, way out, looking at decades of data.
I mean, just look at this chart. It's incredible. This tracks over 2 centuries of the U.S. stock market. Think about everything that's happened in that time. Wars, financial panics, tech bubbles, you name it. And yet, despite all of that, the long-term trend is just remarkably steady. When you adjust for inflation, U.S. stocks have returned about 6.75% a year. Over the long haul, that's not chaos, that's a pattern.
And here's the kicker. Those long-term returns, they aren't magic, and they're not random. This flowchart shows they can be explained, almost perfectly, by the underlying economic engine of the companies themselves. It's a simple formula: real profit growth plus the cash they give back to shareholders. The market's long-term performance is really just a mirror of the economy's long-term performance.
All right, so we've got a pretty good idea of what the market actually cares about, right? Growth and profitability. So now let's flip it. Let's look at 3 super common myths, things that create a ton of noise, but that the smart market is, well, smart enough to ignore.
Myth number 1, the stock split. You've heard of this, right? A company takes its $100 share and turns it into 2 $50 shares. The idea is that this somehow creates value. But it's really like taking one pizza and just cutting it into more slices. You don't have more pizza. So does the market actually fall for this?
Nope, not at all. What the data shows is that a stock's price usually goes up before the split is even announced. So what's going on? Well, it's pretty simple. Companies that do stock splits are usually doing really, really well. The market is reacting to the great business results, not the slice of pizza accounting trick. And then, right after the split happens, poof, the effect is gone.
Okay, on to myth number 2. What happens when a company gets that big fancy invitation to join an index like the S&P 500? You'd think that all the index funds suddenly being forced to buy the stock would give it a permanent boost, right?
Well, the evidence here is just crystal clear. You see that temporary little pop in the price right when it's announced? That's the mad dash from all the index funds buying shares. But then look what happens. Give it about 45 days and that entire effect just vanishes. The stock price settles right back down to where its fundamental value says it belongs.
And that brings us to our final myth, and this is a big one. Can a company pull a fast one with accounting tricks? Can they fudge the numbers to make their earnings report look amazing and fool the market into thinking they're worth more than they are?
Yeah, there's a name for this. It's called earnings management. And companies get pretty creative. They might buy back their own stock to make the earnings per share number look better, or maybe sell off an asset at just the right time to pretty up a quarterly report. They put a ton of energy into this stuff. But the real question is, does the market actually buy it?
And the answer, again and again in the research is no. The market is way too smart for that. It looks right past the flashy earnings number and focuses on the one thing that's harder to fake, actual cash flow. You just can't fool the market for long, because sooner or later, the real financial health of the business always shows.
So, when you put all this evidence together, what's the real takeaway here? I mean, how can we start using this idea of a smart market in our own thinking? Well, it's not some complicated secret formula. It's really just about trying to think like those informed investors. So, step 1, see through all the noise. Just ignore the day-to-day headlines and panic. Step 2, focus on the real fundamentals. That means looking for companies with sustainable growth and high returns on their capital. And step 3, just play the long game. Have the patience to trust that over time, a company's real economic value is what's going to win out.
So it turns out the stock market might not be so random after all. It seems like underneath all that daily craziness, there's a deep, powerful logic at play, which kind of leaves us all with one simple but pretty profound question. The market is smart enough to focus on the long term. Are you?